Great. Thanks, everybody. And thanks to Ken and Ben for doing a great job of teeing this up. When I was talking to Mark about the event, I said, you really have to have a secondaries panel because the secondaries market has become from sort of a fledgling emerging thing maybe a decade ago to a real mainstay of how people generate and create liquidity, whether it's on the GP side or it's on the employee side. And there are a lot of firms that are also buying LP interest from other LPs who have liquidity crunches. Just the time to liquidity has expanded so dramatically since when I came to the Valley in the late 90s. 5 to 7 years was the typical time period for M&A or IPO for a Series A startup. And as Ben pointed out, we're now stretching out to 15 years. I'm going to do a quick introduction of myself. I'm going to ask my three panelists to introduce themselves. They are not going to do a sufficient job. They are all rock stars, so I hope that they're willing to be a little bit immodest and also promote their platforms a little bit as well. But I actually wear three hats. I've been a GP in venture funds now, 4 funds, $2.5 billion under management. I've been in 3 startups, all enterprise technology, 2 sold to public companies. 1 was a spectacular failure. I also help run a single family office. And I'm here in my role as a trustee for the San Jose Pension Fund. I chair the investment committee there. We have $9 billion under management. And during my tenure, we hired a world-class CIO and turned that pension plan around. So lots of learning. So with that, I'm going to also then, after everyone introduces themselves, just ask them each a couple of questions and then quickly turn it over to you folks for questions. And I hope you've got plenty because it's an exciting space. Martha, would you lead us off?
Sure. So Martha Heitman, I'm a partner at LGT Capital Partners. And for those who don't know LGT, we started as the family office for the princely family of Liechtenstein. And then we started to raise third-party capital. So I've been in the secondary space since 2007. When we were investing out of our first fund, it was only $250 million, focused on both LP and GP. But at that time, GP-leds were really not a thing in secondaries. If you fast forward to today, we're raising a $6 billion fund, so it's been significant growth, but also reflects the size of the secondary market, which has also grown tenfold, right? And today is around 110 billion, so only taking around 6% of that market share. We're focused primarily on buyouts, so maybe different from my panelists here. And obviously with our European roots, we're tilted more towards Europe, but have a global view because we have offices and investment hubs here in the US, in Europe, and in Asia.
Awesome. Thanks, Raj.
Thank you. First of all, thanks, Anurag, for including us. Everybody can hear me okay? Okay, good. So my name is Raj Golamudi. I'm with a firm called One Prime Capital that my co-founder Mark Yee and I founded in 2017. And both of us came from Intel Capital. So for the last 7 years, I've been in secondary, but sort of 20-some years prior to that, I was a primary VC. So a lot of what we do at One Prime is sort of informed by that training or being immersed in the sort of technology VC space. So One Prime, very briefly, really came out of our insight or our aha moment, which is that the best private companies, in technology companies, I should say, in the Valley and all over the world are staying private longer and longer. And they're staying private longer and longer because there's so much private capital from all over the world that's coming into those companies. And staying private longer is great, but it means that the liquidity, time to liquidity, as Anurag mentioned, has changed dramatically over the last 10, 15 years. So what we do at One Prime is we identify the best companies in any given sector. We're only focused on technology companies, specifically enterprise software, fintech. We identify the best companies in those spaces, and then we work with those companies to solve their liquidity needs. So one of the questions that comes up is if somebody's an investor in a great company, why are they selling, right? So, and the learning for us over the last 7 years has been that there's so many reasons why people are seeking liquidity. You could be a founder, it could be ex-founder, employee, ex-employee, seed investor, angel investor, corporate VC, all kinds of reasons. And we really cater to that segment of the cap table that is looking for liquidity in companies that are pretty advanced in their sort of evolution. Usually we invest when the company is 8, 10 years old. The average time to exit is now it's closer to 15 years as opposed to 7, 8 years as it was a decade ago. So that's really the business we're in. So we invest in the best technology companies all over the world, mostly in the US, in certain sectors, and our entry is a secondary transaction. And happy to go into all the nuances of what makes that industry exciting and sort of on the move and quite dynamic, but that's what we do.
Terrific. Laura?
I'm Laura Druyan. Have been an operator, a venture capitalist. I've run innovation at a large bank, and I've been a partner at a small fund called Silicon Valley Data Capital for the last several years. And I'm launching with the former head of AI for half of Adobe, a fund focused on single name secondaries, mostly on employees and, of course, early investors. My partner is one of the best data scientists in the Valley. He ran AI at LinkedIn previously, at Yahoo. He was at Microsoft twice, and he's built an engine to identify the most, using AI, using data science to identify the most promising late-stage companies to target. So there are 65,000 venture-backed companies today, and there are about 2,500 that meet our criteria of Series C. Similar to Raj, we focused on software, fintech, things that we really understand. And then Tim has created this beginnings, because we're looking for more data sources and buying more data sources all the time, an engine to pick off the top 50 companies that we think are most likely to exit in the next 3 years, either via IPO or acquisition. So that's what we're focused on.
Thanks. So I'm going to, like I said, just ask a question or two of each of the panelists and then turn it over to you guys. And if you don't have questions, I'll keep going. But Martha has spent the most time in this space, and as she was alluding to, seen it grow. So Martha, any other qualitative thoughts on how markets evolved in the last 2 decades and why GP and LP-led secondaries are growing, and is this sustainable?
Yeah, that's a good question. I mean, if I think back to 2007, the secondary market was around 10 billion. As I said, today it's around 110 billion. So it's really grown 10x, 11x. And is that sustainable? Well, if you think about, so I'm again taking a different view because I look at buyout companies. There's around 28,000 companies, unrealized companies in fund portfolios, right? And that's around $3.2 trillion worth of unrealized companies. These companies need a way to exit, right? And IPOs are 65% down since 2021. Trade sales are down 35%. So, many funds are looking towards the secondary market through GP-leds and finding a way to exit companies through moving them over to an SPV. Is that sustainable exit route? I think so, because GPs would rather reinvest in their trophy assets, continue to hold them, because rather than selling it on and for the next GP to make another 2 or 3x, they'd rather keep those assets, the best assets, right, and drive liquidity at the same time for their underlying LPs, but hold on to the best companies that they have in their portfolios, right? So there's definitely a trend for GP-leds. On the LP portfolio side, we've seen record levels of fundraising in 2021, right? Cash flows were positive for LPs between 2011 and 2019. Then it became negative, right? And so, of course, number one, LPs need to rebalance their portfolios. They're overweight in 21 and 20 vintages. Number two, they have a huge stack of unrealized companies and valuations stuck in those vintages. And then obviously there's also changes in pension funds, family offices. As if a CIO comes in and they want to change from large buyout to small mid-market or more to venture, there's going to be a strategy shift. And how can you rebalance your portfolio? The only way is really through the secondary market. And the secondary market is, if you think about the capital available for secondary transactions, it's around 1 year's worth of transactions of dry powder. And that's really very little dry powder if you consider the size of the secondary market, especially the exponential growth that we see year on year. So I definitely think the growth trends are sustainable going forward.
I hadn't thought about some of that. I'm learning here too. This is terrific. So why don't we, so that was kind of very 50,000 foot and very, very thoughtful. How about we go to about 10 feet? Raj, I'm going to ask you,
How do companies, their management teams, and maybe even the VCs perceive you and your firm working directly with employees to buy off cap tables? What are those dynamics like these days?
Yeah, really good question. And it's really evolved quite a bit over the last decade or so. So just to rewind a bit, really secondaries in technology was very taboo. You couldn't even talk about it. So, I've been a VC in the Valley now for 20 some years, 25 years almost. In the old days, like 10 years ago, you could, if you as a CEO or you as an angel investor or even a VC went to your board or the company that you had invested in and say, hey, I need some liquidity, you'd be laughed out of the room, right? It's just unheard of. You wouldn't think of it. Founders couldn't go to their boards or their investor and say, hey, I need some liquidity for personal reasons. It just didn't happen. So I think the event that kind of changed all of it was Facebook and Twitter. So Facebook and Twitter were seen as such sort of no-brainer wins when they were still private, late stage. And then after that, companies like Uber. So there was a whole bunch of investors, and to be honest, a lot of sort of uninformed investors who say, hey, I can go buy Facebook, buy Twitter in private markets, hold on for a while, and then I'll have an amazing return. So that really opened the door to secondaries in technology. And when I mean secondary directs, which is you're investing in the company as opposed to a fund. And that really changed the entire perception, the stigma that was associated with secondaries. The problem with secondaries, and this is true even today, is access to information. Because if you were buying Facebook 6 months or a year before they went public, you didn't really ask, hey, what are their revenues? What are their margins? You just bought it because it was Facebook. And today that's true of companies like SpaceX, for example. People are just buying SpaceX in the secondary market, having no idea what their revenues are, what their growth projections are. It's SpaceX, so it's SpaceX, right? So I think that continues to be one of the challenges in the secondary market. I think companies, and I would say the more advanced, the more evolved companies are starting to recognize that they need to think about secondaries in a more strategic, deliberate, intentional way. And there's two reasons for that. One is sort of very real reasons, like Stripe went through last year, where they had employee options expiring. So as most of you know, you have options are 10-year options. When they expire, you have to do something with them, right? You have to exercise them. And oftentimes there's a big tax liability, so on and so forth. So then that became a real problem, not just for the individual, but for the company, because employees would say, I'm going to leave and go to a company where I can get liquid stock as opposed to being stuck in this liquid asset. So that's why Stripe, for example, last year did a $7 billion secondary, essentially buying back shares from a whole bunch of employees whose options were expiring. It's $7 billion, think about that, in private capital, one company. So that's where secondaries have evolved to now companies, more and more companies, especially the later stage ones, the ones that are doing well, are starting to wake up to this fact that there's tactical reasons why they need to think about secondaries and a more strategic reason, which is it's becoming an important recruiting and retention tool. So if you're able to go to your employees and say, hey, you don't need to go join Microsoft, Google, Meta. We can provide an organized liquidity program on every year or every 18 months or every 24 months. So you can be liquid in your stock as it vests. And the companies usually set up some kind of formula where they say 10% of your vested shares you can sell on a regular basis. So they're talking to firms like us and other firms who are in the secondary business to set up more organized secondary. They call employee tenders. So that's happening. So I would say it's still early days, which is why we're excited about sort of the growth of this market. It's still early days where the best companies are now being more proactive in pursuing employee tenders, secondary transactions, especially in a market like we're in now where financings are not that common, right? So there's not that much money for primary financings. So what happened in the 21 bubble is that a company would raise, let's say, $300 million in financing. Of half of that would be primary and half of that would be secondary. So they would the companies would organize a secondary for employees, early stage investors to get them off the cap table, consolidate ownership in the firms that actually wanted to be there longer term. So short answer to your question is it is changing quite a bit. The way companies, boards, investors are thinking about secondaries, they're thinking about it more strategically as opposed to as a nuisance they don't want to deal with. because it is kind of a nuisance when every employee every second week comes to you and say, "I want to sell my shares." So they're trying to be more proactive and strategic about it.
So you made me remember something. I was at one of the early crossover funds in Silicon Valley, and we were we were interested in a deal in 2008. And to win the deal, we actually had to provide some secondary financing to the CEO and a founder. And we sat and wrangled over this as a partnership for like 30 minutes because we just thought it was a terrible signal. They want to sell I mean, it sounds so quaint now.
Yeah.
So we came up with a formula. We figured out the zip codes that these people lived in. We tried to figure out the formula for them paying off their mortgage and fully funding their kids' college funds. And then, add the tax liability. Usually it was like around 5 million. This is the Bay Area, right? So we're like, yeah, we'll give them 5 million. That's such a joke now, the amount of money that, Raj referred to the $7 billion coming just out of one company. So Raj said something that I think is a great tee up for you, Laura, because you guys are using data science in a very sophisticated and cutting edge way to identify a pool of companies. But I know you for 20 years and you are a diligence maven, understand the importance of asymmetric information in Silicon Valley, which is, I think, the most valuable asset. How are you thinking about combining the two at PLP to make your decisions and find your companies?
Yeah, I'm not a big believer in just a black box. I think you have to do fundamental diligence. It's great to have data science help cull down a list of promising companies, but we're operators, we're investors, we've been angel investors, so we're really well connected. So when the Stripe secondary was going down, so Stripe secondary, good friend of mine is a senior executive at Stripe, and Stripe had been valued about 90 billion. Goldman built the secondary book at a valuation of 55 billion, so the nadir of the market a year ago. And Stripe was a mess when that secondary transaction happened. They were hemorrhaging cash, and they hired a person like Ken, who's been CFO of 5 different public companies, who really turned it around operationally. So Stripe went from cash flow negative to 500 million in EBITDA positive. I know this because this is a guy who has Christmas dinner at my house. So, and he's like, you should hoover up as much Stripe as you can. It is hard to have that information if you don't have trusted relationships in the Valley who are people who are going to tell you these things. So we believe that combining our networks with the right questions to ask will help us make much better decisions. And we consider that fundamental diligence as opposed to just using a box to say, go buy this. We're not Citadel, and there's a lot less information out there.
I'm going to sneak in one more question for each of them. If you guys can keep the answers relatively brief, but also thorough at the same time. I am fascinated with the continuation fund movement. I don't like it. I'm not sure why GPs are getting paid again for what their original promise was to their LPs. I would love Martha to Chatham's House rules, give us her full opinion on them.
I mean, it is full of conflicts, right? The GP is both a buyer and a seller. You have to make sure that the LPs that are in the funds are happy and are maximizing the price for them versus the LPs that are coming in as the new buyer. It's inherent. There's full of conflicts. But what can you do? As a buyer, if I take a buyer's point of view, I want to make sure that the GP is a net buyer and not a net seller, right? And I think the former panelists, they said, you have to have skin in the game. That's absolutely true here. You want to have alignment with the GP, make sure that they think that's a good entry point too. And so having some GP commit that is at least 100% of their carry rolled over into the new vehicle, plus more equity into that deal gives comfort to the buyer, right? On the seller side, I think when you're thinking about the continuation funds, you want to make sure that there was a market run process and that the LPs were given a maximized price, right, in the market. So I would make sure you understand the process. It's not just a bilateral discussion with one secondary player that they just take the offer. You want to make sure that the process was well run. And SEC has now come out with all those regulations to ensure that there is a fair and transparent process.
No, that's really helpful. I struggle with it. We have struggled with it at San Jose as well. Raj, question for you, since you're in the mechanics of trying to buy secondaries from employees.
I mean, I'm sure there's motivated employees, but is there an education process? Is there a wooing process? Like, how do you get enough allocation? Just a little bit of the inside baseball.
And I have to ask to be really brief because we have to interact a little more.
Yeah.
Okay.
Yeah, so very briefly, so I think, yes, a lot of education. I think some of the companies are doing a better job of educating their employees. We do that as well. But it really comes down to what their needs are, right? So if you're selling because you will sell if it's a good price, that's one sort of dynamic. If you're selling because you have to sell, you want to get it done quickly, you have an urgent liquidity need, it's a different. But it's really very much bespoke.
And Lara, I just wanted to ask you, how does the venture community perceive people? Are you friend? Are you foe? How does
I think
that?
it depends on the fund. So I've met with 2 managing partners at funds who are like, we don't trust most people in the secondary space, but we know you and we trust you. So we will give you any information you want about if our companies are on your list. They hate Forge Global. They find it really disruptive because Forge and Equity Zen are calling employees all the time to ask, hey, do you want to sell some stock? So they're like, whatever we can do to get rid of that, it's really a distraction for our employees.
Just open it
So
up.
yeah, let's open it up. One second, Catherine, if you don't just mind introducing yourself.
Are people raising their hand on Zoom? I don't know. how that
Thanks,
works.
thanks. I'm Catherine Shung. I run a single-family office, and we bought 90 million of Uber prior from HNA. And people remember the story about HNA CEO, right? He did a selfie and fell off a cliff in France, and which exposed HNA. And so they were forced to sell a lot of their prized assets from realty. Basically, their portfolio got deconstructed. We were the fastest close, but it was, going to Raj's point, an asymmetric information. By the time they got to us, they were running out of runway. And that block, the 90 million block, had been sitting out there for 9 months. And we didn't know about it until the very, very end. And we closed it in 45 days, which is one of the fastest close if you do secondaries. All right, cash over. Hey, how you doing? And so my concern here is that we get hit up constantly for secondary blocks, and we like them big, tend to go for the 30 million to 50 million range. The issue here is that we have a lot of false brokers or daisy chain of brokers, and we don't want to deal with it, and we're always on the buy side. I would like to see, and Forge comes to us, Equity Zen and all of those guys, but they're kind of poker faced because they claim they've got a block, but they don't. They're just fishing. And we also tend to have ROFR issues. And so what you asked was really relevant. 2 things. How do we clean up the secondary market for the trades? And 2, how do we really get the company, the CFO who's trying to build a decent cap table, trying to preserve his value, try to preserve his relationship, plus honor some of the push for liquidity right now because everybody's kind of constipated with the IPO market the way it is. So those are 2 questions I'd love this expert panel to help me out with.
Yeah, so I think you bring up a very good point. I think the industry, and we hear this all the time because we get painted with the same brush. It's like, oh, you're a secondary firm. It's a bunch of fly-by-night operators. So I think the answer is, longer-term answer, I don't know how fast this happens, is that companies need to be more evolved in their thinking. They need to see secondary as an important strategic tool in their employee retention and recruiting, as opposed to a nuisance. Because a lot of companies today, I would say a vast majority, pretend that secondaries don't happen in their companies, right? So which is, they don't allow it, they block it. So that's why you have these fly-by-night, the Forges and there's a firm called Setter in Canada, completely just terrible. There's a whole bunch of these firms. And like you said, daisy chain, there's really, fictitious supply and fictitious demand, all this stuff happens. So I think the real solution is companies have to get involved in solving this problem. And I think hopefully firms like Lara's, ours, bring credibility to this and we become bigger and bigger. So there's more of us. Right now, there's so few of us. That's the problem. And so it's amazing when we talk to LPs, how few firms there are like our firms. Just very few, right? So I think that there needs to be more firms like us. Companies need to be more evolved. And they will get more evolved if there's more trustworthy firms like us. I think Carta, for example, tried to do this, right? Blew up in their face because they tried to.
And ruin the reputation for the rest of their business.
Exactly. So they really could have,
Really supportive what Carter, I think that they had the wrong person running their secondary, who only had retail experience from Merrill Lynch, I think, selling, puppy stocks to people, and she didn't understand a simple consent, right? So,
No, yeah, but I think they absolutely had the right idea, which is so Econ 101, right? Markets, good marketplaces need liquidity. So they understood that. I think the problem is they didn't understand how sensitive information was to companies, and they didn't get companies as involved. So I think companies need to get more involved. And I think that happened over time. It's already happening. You're seeing just in the last 3 months, you've had big firms like Rippling and so on and so forth do big secondaries as part of the fundraising. So you see more and more of that.
Laura and Martha?
Well, we don't compete with Raj because we don't go into companies directly. But what we do is work with the GPs that we're investing in, because we're in 600 GPs, right? And 5,000 funds. Work with the funds to understand, okay, is there an outsized position? Do they want to decrease their exposure in one company? Maybe it's a seed stage, but one company has become 20x within the fund. Then we can, set up a SPV with the GP, right? Because then there is no conflict with the cap table, and then fund the SPV and get the shares through that, so that we are not on the cap table, the GP remains on the cap table. But we can structure things around it so that, we can circumvent the ROFR issue, right? But you have to work with a credible buyer.
Laura?
Yeah, we have something that we're working on with a large financial institution to solve exactly what you're talking about and perfecting the interest in the collateral. And I don't want to say more because it's a partnership we haven't inked yet.
Yeah, before the next question, I'm just going to answer with a slightly different angle, because I have relationships with an asset management firm in India. I was with a Russian venture fund. That's a story for the cocktail hour. And relationships in Dubai. I get phone calls, get me into SpaceX, get me into Uber. And, really the answer is, by the time if it's a household name in Dubai, in Mumbai, and in Moscow, it's already too late. There's already a chain of 7,000 middle people who want to get involved. And my answer to all of them is, you should have given me the money 3 years ago, because I could have gotten you into Looker. You don't even know who they are. I was on executive staff with the management team at my first startup. Like, there's so many ways for us to identify these companies before they become household names and have that private one-to-one, party-to-party transaction. So, Mark, any other questions out there?
Well, other comments, questions?
Ben?
It's interesting. So as I said, I was a seed investor in Rippling. So I actually sat in on their call for the secondary. I wasn't selling anything in it. And one of the things the company said that really made me think, because I'd never been exposed to this before, was we don't support secondary sales in the open market. We don't like them, although I did one to raise money for my fund. I will tell you that in advance. Because what happened in the past, they claim, is when one VC won the deal to do our next funding round, all the other VCs that were in competition with them went out and bought shares in the secondary market at the current price and then flipped them after the round was announced, which I just thought was fascinating. I don't know those VCs, but I will say, I was interested in your question, Anurag, because these continuation funds are fascinating to me. Obviously, NEA is doing a big one. And there was one that failed recently. Redpoint, was it?
The Shasta Ventures.
Shasta, right. So I'd love your view on why it failed. Was it because it was too big of a discount or too small? But as you think about sort of, as Anurag, you were positing it was a negative, it reminds me of, there's 3 Christmas parties in Silicon Valley every year. And I used to go to one. I went to all of them, but I went to one, and every year I'd ask the same partner, hey, how about that company that I really want to invest in? Oh, it's doing great. Is there room for me? Not yet. And on the 10th year I asked, he said, oh, I don't really know. I said, what do you mean? He said, well, I'm not on the board anymore. I'm like, why not? He said, it's in a runoff fund. I was like, what's that? He said, we're not getting fees anymore. So we don't manage it. It's our CFO's job. You can ask him. So it feels like it's a better alignment of interest for the VC to sell themselves the company at fair open market prices than to shove it into some CFO administered runoff fund that gets neglected and never touched. Is that fair?
Before Martha, I think that's fair. It doesn't mean I have to like it. I mean, I study public policy, and it's all trade-offs. Everyone's like, we're going to do this, and we're going to save the climate doing this, not at all paying attention to all the trade-offs, right? So you've hit it bothers me emotionally, because it shouldn't have been passed off to the CFO to begin with. There's a fiduciary duty there. I just explained to someone's son who's 18 years old, who's a genius, who just raised $2 million down in Orange County for a startup, that he now has a solemn obligation to those people. He can't go to his prom. I mean, he might go to his prom, but like he has to make those kinds of sacrifices, right? And
No
so,
longer allowed to
so I
sleep.
understand. I want Martha to give an expert answer. I'm giving you my emotional answer.
No, I mean, I think it was 10 years ago that, when continuation funds started, these were zombie funds, right? Solutions for zombie funds, and the assets that were sort of remaining in the funds, leftovers that couldn't be sold, were then transferred into an SPV and found a solution for. But today that's changed because there's so much deal volume on the secondary side that you have to sell the best assets. Otherwise, there's no transaction to be had. And I think the other thing that you're missing is that there's a lot of team turnover in these large venture funds, right, or growth funds. And so that's why a lot of these companies get orphaned. And by doing this continuation fund, you give the relevant economics to the team that is managing the assets rather than the economics that were tied to people who've left, right? So that's also.
There's constant churn. The companies get orphaned. The secondary fund that NEA did right as I was leaving was exactly that. You don't have a sponsor. I've had entrepreneurs
Yeah.
call me before. What do I do? My partner's leaving. You're screwed. You're going to be an orphan. No one's going to care
Yeah.
about you. If they assign somebody, they're not going to do anything for you because they can only lose if you go poorly. They get no credit if you go well.
One more
But what
question.
about, sorry, Shasta? I would love your view on why Shasta failed.
Yeah,
We
I
have,
mean-
we have the drinks at some point. I have to because we're supposed to actually we're supposed to take a break.
Mark, I actually
Yeah.
know a little bit about Shasta.
All right, you can,
Don't we have till 3? I got my time wrong? We got till 3:45?
well, we have to take a break. I was actually to 3:30. It doesn't say break.
we can just.
Oh, there's no break up there. Everyone wants to know about Shasta now. Just 2 minutes on Shasta.
Because it's your question. Fine, Shasta.
Well,
What's your knowledge on Shasta?
How do I speak? Like this?
Yes, sorry. There you go.
Yeah, I know too much, so I'll have to be careful what I say, but I think it was a question of the discount and the future fees and structure and how some of the institutions didn't feel good about, they actually felt better about the current portfolio and they basically voted against it because they actually didn't like the fee structure going forward. I think what I also wanted to comment on it is what I see is separate venture from PE. In the venture, what I see is unfortunately many funds spent all their committed funds and now they're stuck. And I'm amazed at how many funds that I know well makes venture, in my opinion, venture 101 mistake where they don't have enough reserves. And so then they create either SPVs or continuation funds or something because they can't, either they could be in pay to play or they could be in, good companies and they actually, in those cases, they do SPVs. So I think you have part of that. I do think, it's funny, I was talking credit funds earlier, secondary funds are everywhere. There's not a PE fund that I know that doesn't have a secondary fund. Everyone has a secondary fund now. It used to be a few known firms, the Lexingtons of the world. Now every Tom, Dick, and Harry has a secondary fund. I mean, they're everywhere. At least in the private equity space, you're dealing with real companies that you have a good sense of the valuation. I know Leonard Green, they did for one of the most successful ones, they did a SPV, a continuation fund, and they're going to have a great outcome in that. So those, I think, in general, it makes sense. I think in the venture, it comes back to my earlier concern is too many companies that are great companies stay private too long. I've done 3 IPOs myself, and we felt real companies go public. That's not quote. I have to be careful what I say it. That's not the way people think about it these days. There used to be real men run wafer fabs, but that's another comment. And so I do think it's a problem right now. I honestly think it's a real problem. There's too much capital. There's 400 billion in venture, and it's looking for a home. And so many of the founders don't want to go public because they're very happy running a private company. They've taken a fair amount of money. Data Robot, best example, got a whole bunch of money, stayed private, and it's a mistake. And I think, frankly, for those in this room, and I ask the question all the time when you guys do secondaries, how do you think you can get liquidity? Because you could just be buying into another situation where the companies want to stay private long and long, and you think it's a 3 to 5 year exit, where it could be a 10-year exit. So I think that's a challenge which didn't exist, we talked about earlier, in the 70s, 80s, and 90s, that exists today in the venture market. And I think it has to get sorted out sooner than later for the venture market to get back to giving good returns to LPs. And by the way, I just say, if you don't think you can get a good, when you're locking up your money for illiquidity, if you don't think you can get, a good, better return than the stock market, and which in the stock market overall is 10% overall, or or better, a teens return, just sort of say, why bother? And that's, I think, part of the problem in venture right now. In many of the cases, you can't be assured of a decent return in a set number of years. And funds that used to, by the way, what fund, they talk about funds that 10-year life. What fund do you know has a 10-year life anymore? There aren't any. 15. I can guarantee you not a single fund has a 10-year life anymore. But that's been the going thing, 10-year life. Every fund I'm in, every single fund, I have funds been around 15, 20 years. And Laura, you know some, that are they're still going, and half of their assets are still around. It's unbelievable. So that's what I worry about in venture.
Martha, you want to give us a close?
I think that, Ken, so one of the things that has changed is that when you actually aren't daisy chained and you actually have, whether it's a contract or the stock, a lot of companies are very happy to buy the stock back because they don't want a distributed cap table.
Martha, do you have a final thought on that? Or?
No, I mean, I think that's, the continuation fund space for venture, that's the reason why it's also 10 years behind buyouts, right? Because, I mean, the lack of liquidity, the uncertainty of exits, secondary is dependent on IRR, and you want to get cash back quickly, right? And that de-risking is very difficult. So, I mean, in the last 5 months, I've seen billion-dollar venture fund secondaries, like the Shasta, like the NEA, but a bunch more, right? Where everyone's trying to find liquidity, but it's really difficult. And I think the other issue with Shasta was that, you've got one key asset, it was very concentrated. Everybody knew the last round, and there was a significant discount to that last round. And so, of course, the LPAC said no to that transaction, right? Too much transparency. So I think on venture funds, it's going to be difficult. And that's probably why, you need to have that venture expertise, which I'm saying I don't have, right? So we're only focused on buyouts and cash flows, and where you can see the Leonard Green, SRS exit in sight. Exactly.
So
I know.
So Anurag said last comment, so you have to blame it on you now.
That was the last comment.
All right.
And I hope you guys get a chance to spend time later during the cocktail hour with this amazing panel.
Yes, thank you, everybody.